Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, April 9th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with the today's key macro event, which is leading survey data send mixed signals for the immaculate disinflation theme. So the nuance there is that the latest leading survey data are mixed regarding their signaling for tomorrow's US CPI print. The March in the New York Fed inflation expectations print was supportive of the immaculate disinflation theme, while the March NFIB small business optimism survey results were supportive of our developing sticky inflation theme. In terms of the market implications, investors continue to get paid on the long side of commodities and cyclicals and on the short side of bonds. Three obvious bets discretionary investors should have been making in a risk-on market regime, which is currently reflation. Refer to the proper trade recommendations in our discretionary risk management overlay for more details. We refresh that model 6 days a week for 42 Macro clients. Thanks to our resilient U.S. economy, China front-loading stimulus, and green shoots globally themes, we have kept clients on the right side of these market risks and continue to see ample upside in commodities and cyclicals over the medium term. Commodities in particular are one of the best ways to survive the pending transition from a risk-on reflation to a risk-off inflation market regime, which we currently anticipate will occur in Q3. So as always, wrapping up with a question from our community here in the 42 Macro dashboard. So the question reads, market data says, hi, Darius, I'm studying the market from an economic perspective, and I'm trying to understand the relationships and reactions of the markets to various events. Questions about gold. How does it react to interest rate cuts? Does gold reaction vary depending on the geopolitical situation? So the question, the answer there is gold. It's typically, the word typically is very aggressive there. So gold generally is inversely correlated to real interest rates, and it's generally more so inversely correlated to the U.S. dollar. When we backtest asset markets, as we've done here through the lens of expected returns, volatility, covariance, and performance percent positive ratios, we've done that process with respect to our grid regime process for every asset class that ticks across global macro, and gold is one of the more peculiar of the backtests. So most asset classes have a pretty clear definition in terms of what really drives the asset class. Is it growth, either accelerating or decelerating, or inflation accelerating or decelerating? Because typically when things like inflation are accelerating and decelerating, you typically have very sticky and stable responses in the bond market. Interest rates are going up or going down, both nominal and real. You tend to have sticky and stable responses in the currency market to changes in the delta on growth and inflation. Gold, that back test is all over the place in the sense that there's really no sticky or no stability with respect to what's causing dispersion in the gold price. And so what that tells me is that the drivers, the principal components of the gold price are changing over time. They're not as stable as they are for something like the stock market or the bond market or the currency market or Bitcoin, for example. So that's a long-winded way of saying is that, if you're using a single factor model or even a multi-factor model on gold, trying to isolate what's actually driving the gold price higher or lower, you need to understand that those models, those drivers will fall out of significance over time and to be replaced by other drivers over time. And so then that process happens all the time with all asset markets, but that process typically takes decades for most asset markets in terms of drivers becoming less important or more important over time. For us with gold, it seems like it happens, every few years. And so just be aware that if you're trading gold, you can't just say, okay, interest rate cuts are coming, therefore I got to buy gold, or the geopolitical risk is rising, therefore I got to buy gold. It might matter in this particular market cycle, but it may not be stable across market cycles. So you need to basically have a quantitative process that allows you to stay on the right side of gold price risk that is separate and apart from whatever you think is driving the gold price fundamentally, because it's probably going to be wrong, as soon as, next couple of years. So just be aware of that. So we'll wrap it up there. As always, thanks for joining us. Darius Dale presenting our macro minute for Tuesday, April 9th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.